everyone, welcome to our podcast, where we help you learn English in a fun and easy way. My name is Elena.
And I'm Jack. Today, we have a very interesting topic, trading. Many people hear this word, but what does it really mean? Today, we will talk about trading, explain it in a simple way, and help you learn new English words.
Yes, before we start, let's go over some important words that we will use today. These words will help you understand trading better.
Great idea. Our first word is trading. Trading means buying and selling things, usually to make money. Example, John makes money by trading stocks in the market.
The second word is market. A market is a place where people buy and sell things. This can be a real place, like a store, or an online place, like a website. Example, Lisa sells fruit in the market every morning.
Next, we have invest. To invest means to put money into something, like stocks or a business, hoping to make more money later. Example, Mike invested $500 in a new company.
Another important word is profit. Profit is the extra money you make after selling something for more than it cost you. Example, Anna bought a watch for $50 and sold it for $80. Her profit was $30.
Good one. Now, let's talk about loss. A loss happens when you sell something for less than you paid for it. Example, Tom bought a phone for $200 but sold it for $150. He had a loss of $50.
Next is stock. A stock is a small part of a company that people can buy. If you own a stock, you own a small piece of that company. Example, Jane bought stocks in a big technology company.
We also have broker. A broker is a person or company that helps people buy and sell stocks or other things in the market. Example, John called his broker to buy some stocks.
And the last word is risk. Risk means the chance of losing money. When you invest, there is always some risk. Example, trading has a high risk, so be careful with your money.
That was a great list. Now, let's start talking about trading. Trading is everywhere. When you buy a snack from a store, that's a kind of trading. The store sells it, and you buy it. But today, we are talking about a different kind of trading, buying and selling things like stocks, gold, and even money from other countries.
Yes, many people trade stocks. A stock is like a small piece of a company. When you buy a stock, you own a little part of that company. If the company does well, the stock price goes up, and you can sell it for more money. If the company does badly, the stock price goes down, and you may lose money.
That's why people need to be careful when trading stocks. Some people make a lot of money, but others lose money. It depends on the market. Sometimes prices go up, and sometimes they go down.
Exactly, and that's why people study the market before they invest. They look at news, company reports, and other information to decide if a stock is a good investment or too risky.
And if you don't know much about stocks, you can ask a broker for help. A broker helps people buy and sell stocks. Some brokers work in big offices, and others work online.
Yes, some people trade stocks every day. This is called day trading. Day traders buy stocks in the morning and sell them before the day ends. They try to make a small profit many times.
But trading is not only about stocks. People also trade things like gold, oil, and even currencies that means money from different countries.
Right, if you travel to another country, you need to exchange your money for that country's money. This is called foreign exchange trading, or forex trading. Some people try to make money by buying and selling different currencies.
That's true. The price of money changes all the time. For example, today, $1 might be worth €1. Tomorrow, it might be worth more or less. Traders try to buy at a low price and sell at a high price.
But just like with stocks, there is always a risk. If the price goes down, traders lose money. That's why it's important to learn before you start trading.
Yes, some people think trading is easy, but it takes time to understand how it works. People who trade successfully study the market, read the news, and make smart choices.
And some people trade for fun, but others trade as their job. Professional traders work for big companies or banks. They make trades for their company to help it grow.
That's true. And now, let's continue our conversation about trading. There's still a lot to talk about.
Yes, and one interesting thing about trading is that there are different ways to do it. Some people trade quickly, buying and selling in a short time, while others hold their investments for many years.
That's right. People who buy and sell quickly are called day traders. They try to make small profits many times during the day, but this can be stressful because prices change very fast.
Yes, and then we have long-term investors. These people buy stocks and keep them for months or even years. They believe that over time, the stock price will go up, even if it sometimes goes down.
Many people like long-term investing because it's less stressful than day trading. They don't have to watch the market every minute. They just wait and let their money grow over time.
But whether you are a day trader or a long-term investor, one thing is very important: understanding market trends.
Good point. A market trend is the general direction that prices are moving. If prices are going up for a long time, we call it a bull market. If prices are going down for a long time, we call it a bear market.
And these trends help traders decide what to do. In a bull market, many people buy stocks because they think prices will keep going up. In a bear market, many people sell stocks because they are afraid of losing money.
That's why traders study charts, news, and reports. They look for clues to guess if prices will go up or down.
Yes, and some traders use technical analysis. This means they look at past prices and charts to find patterns. They believe that past trends can help them predict future prices.
Others use fundamental analysis. This means they study a company's business, its profits, and the economy to decide if it's a good investment.
Both methods can be helpful, but no one can predict the future perfectly. The market can be full of surprises.
That's why risk management is so important. Traders never put all their money into one stock or one trade. They diversify. That means they invest in different things to reduce risk.
Yes, if one stock goes down, they don't lose everything because they have other investments that might go up.
Smart traders always have a plan. They decide how much money they are willing to risk before making a trade.
And they don't let emotions control them. Many people panic when prices go down and sell too quickly, or they get too excited when prices go up and buy too much.
Exactly. Good traders stay calm and follow their plan.
And speaking of emotions, let's talk about another type of trading: cryptocurrency trading.
Oh yes! Cryptocurrency, like Bitcoin and Ethereum, is a new and exciting type of trading, but it is also very risky because prices change very quickly.
Many people love crypto trading because it is open 24/7, meaning you can trade anytime, even at night or on weekends.
That's different from the stock market, which has opening and closing times. But because crypto never stops, prices can change suddenly, and traders have to be very careful.
Yes, and since cryptocurrency is still new, no one knows for sure what will happen in the future. Some people believe it will grow a lot, while others think it's too risky.
And just like stocks, people use different strategies for crypto trading. Some buy and hold for a long time, and others try to make quick profits.
But no matter what kind of trading you do, learning is the most important thing. Traders need to study and understand the market before they start.
Yes! And let's continue talking about trading strategies and how people decide when to buy and sell.
That's a great point. Knowing when to buy and sell is one of the hardest parts of trading. Many traders use different strategies to help them decide.
Yes! One common strategy is called buy low, sell high. This means traders try to buy when prices are low and sell when prices go up to make a profit.
But it's not always easy to know when the price is really low or high. That's why traders use indicators, special tools that help them understand market trends.
One popular indicator is called the moving average. It shows the average price of a stock over time, helping traders see if prices are generally going up or down.
Yes, another common indicator is called support and resistance levels. Support is the price level where a stock usually stops falling, and resistance is the level where it usually stops rising. Traders use these levels to decide when to buy or sell.
And then there's stop-loss orders. This is a tool traders use to protect themselves. They set a price where the system automatically sells their stock if the price goes too low.
That's very useful. Stop-loss orders help traders avoid big losses, especially when the market is moving fast.
Another strategy is dollar cost averaging. This means investing a fixed amount of money regularly, no matter if prices are high or low. Over time, this helps reduce risk because you are not buying everything at one price.
That's a smart way to invest, especially for beginners. It helps reduce the risk of making a bad decision at the wrong time.
Yes, and speaking of beginners, many new traders start by practicing with a demo account. This is a special trading account where you can trade with fake money to learn how the market works.
That's a great way to learn. It lets beginners try different strategies without losing real money.
But of course, trading with real money feels very different. When real money is involved, emotions can make people act differently.
That's true. Some people get too excited and take big risks, while others get scared and sell too early. That's why it's important to stay calm and follow a plan.
Another important thing is keeping up with the news. Big events like elections, economic reports, or company news can make stock prices move suddenly.
Yes, for example, if a company announces good news, like high profits, its stock price might go up. But if there is bad news, like a big company losing money, the stock price might go down.
That's why many traders check the news every day. They want to be ready for any big changes in the market.
And not just company news, things like interest rates, inflation, and even world events can affect the market.
Exactly. That's why trading is not just about numbers. It's also about understanding how the world works and how people react to news.
Yes, and now let's talk about some common mistakes that new traders make and how to avoid them.
That's a great idea. Many new traders make mistakes when they start, and understanding these mistakes can help them avoid losing money.
Yes, one of the biggest mistakes is not having a plan. Some people buy stocks just because they feel lucky or see other people buying. But without a plan, they don't know when to sell or how to manage their risk.
That's true. A good trader always has a plan before making a trade. They decide how much money they are willing to risk and when they will sell, whether they make a profit or a loss.
Another common mistake is investing too much money in one stock. Some people put all their money into one company, hoping to make big profits. But if that company loses value, they lose everything.
That's why diversification is so important. Instead of putting all your money into one stock, it's safer to invest in different companies or assets.
Yes, that way, if one stock goes down, your other investments might go up, balancing your losses.
Another mistake is trading with emotions. When people see stock prices going up fast, they get excited and buy without thinking. And when prices go down, they panic and sell too quickly.
Yes, successful traders stay calm. They don't let fear or excitement control their decisions. They follow their strategy and think logically.
Another mistake is not learning enough before trading. Some beginners start trading without understanding how the market works. They don't study trends, charts, or company reports.
Yes, trading is not gambling. It's important to learn, practice, and improve before risking real money.
And speaking of learning, another mistake is not using stop-loss orders. Some traders don't set a stop-loss, and when prices drop, they lose a lot more money than they expected.
Yes, stop-loss orders are very useful because they automatically sell your stock if the price drops too much. This helps protect your money.
And one more big mistake is trying to get rich quickly. Some people think trading will make them rich overnight, but successful traders know that making money takes time, patience, and experience.
That's so true. Trading is a skill, and like any skill, it takes practice to get better. The best traders keep learning and improving every day.
Exactly. And now, let's talk about some final tips for becoming a smart and successful trader.
Yes, if you want to be a smart and successful trader, you need to keep learning and practicing. Trading is not just about luck, it's about knowledge, patience, and good decision-making.
That's right. And one of the best ways to improve is by starting small. Many beginners lose a lot of money because they take big risks too early. It's better to start with a small amount and learn from experience.
Yes, and always remember to manage your risk. Never invest money that you can't afford to lose. The market can go up and down, and there are no guarantees.
Another important thing is to stay updated with market news. Big events in the economy, politics, or business can change prices very quickly.
Exactly, many traders check the news every day, watch economic reports, and follow company updates to make better decisions.
And don't forget to stay patient. Many people get frustrated when they don't make money fast, but successful traders know that profits take time.
Yes, and mistakes are part of the learning process. Even professional traders lose money sometimes. The key is to learn from mistakes and keep improving.
So, let's quickly summarize what we talked about today.
We started by explaining what trading is and why people do it. We talked about different types of trading, like day trading and long-term investing.
We also discussed market trends, bull and bear markets, and how traders decide when to buy and sell.
Then, we talked about trading strategies, technical and fundamental analysis, and risk management.
We also looked at common mistakes that beginners make, like trading with emotions, not diversifying, and trying to get rich quickly.
And finally, we shared some important tips starting small, managing risk, staying informed, and being patient.
Trading can be exciting and rewarding, but it's important to learn and practice before taking big risks.
We hope you found this podcast useful. If you liked it, please subscribe to our channel, give this podcast a thumbs up, and share it with your friends and family who are learning English.
And don't forget to leave a comment. Tell us what you learned today or ask any questions. We love hearing from you.
Thank you so much for listening. Keep learning, keep practicing, and we'll see you next time.
Goodbye and happy trading!